I'll present for about 10 minutes, sharing with you the story of Argonaut Gold. I have been in this business for some 30 years and had the opportunity to run two other companies that have been very successful before this one, and we're really starting something special here. So Argonaut is a junior producer, producing about 200,000 ounces a year in the Americas. So forward-looking statements, as we have a brief amount of time here, I'll just share with you that we're all going to share with you during this conference our best expectations of what may or may not happen in the future, but they are our best expectations at this time. So where is Argonaut today? As I said, we are in the Americas, focused primarily in Canada and in Mexico today. As I said before, we're producing about 200,000 ounces of gold per annum, doing that at about an all-in cost somewhere around $1,000 to $1,100 per ounce. Now, when we look at the reserve or the resource base that Richard kind of pointed out with his company, we're sitting on today around 8 million ounces in resources and 3.5 million ounces in reserve. We have an opportunity here by the end of the year to increase those resources by over 2 million ounces and that reserve by about 1.7 million ounces. So a handsome growth there, somewhere in the neighborhood of 50% in the reserve base and nearly 25% in the resource base. As you can see, the country split there between the US and Canada and in Mexico. Our headquarters are in the US. We have on the map here 3 red dots. Those are the producing assets today. And then the 3 development assets in the yellow dots. The interesting thing about this company is for the size company that we are, we have all 3 of those yellow dots nearing completion of permits and advancing towards construction decisions here in the next short little while. 2 of them by the end of the year and the 3rd one by the fall of next year. So when we look at Argonaut Gold, the company's been around for roughly 10 years. We set a goal back in 2017 to change the future of the company, to change where it was from this 125,000 ounce a year producer, to move that to a 200,000 ounce market range. We have successfully been able to demonstrate that growth rate. Last year we were up to 165,000 ounces, and this year the expectation is 200,000 ounces and a like profile next year. Now, why is that important as we look forward into next year and what's happening? With a similar production profile, lower operating costs coming to the table, and a significantly reduced capital profile leads to greater cash flow. You heard earlier on the panel today, people are still looking for cash flow, and that cash to generate and build the next future round of projects and the growth for the companies. With all companies, we are extracting on a daily basis. Therefore, reserve and resource bases are shrinking on a daily basis. We have some interesting developments going on within the company today. At our Magino project, which is a large-scale project up in Canada, holding already 5 million ounces of gold in the top 300 meters, from 0 to 300 meters of the pit depth, we have 5 million ounces identified. Recently, we've started to drill deeper to focus on the mineralization right next door and underneath at the Island Gold project. We have been successful in identifying those targets, and now we're drilling them deeper and plunge and hoping to add additional resource there. This becomes very exciting for this project because this today is an open cast project with a grade of about 1.2 grams per ton. Next door, they are mining underground at anywhere from 600 to 1,000 meters depth at 10 grams per ton. It happens to be one of the largest, the best quality underground projects in all of the world and the greatest asset within the Alamos portfolio. So if we can tap into those same structures, which we believe we have, and follow them to depth, it could change the profile and outlook for this project in the future. Additionally, we have another project called Serra de Gallo down in Mexico. We bought this project just a little over a year ago, and we've done some work on it. To date, what has been released by the prior owners was a project that held roughly 1.7 million ounces of gold, 35 million ounces of silver, and 150 million pounds of copper. We will be issuing this year a pre-feasibility study that will transform those ounces into our actual resources and reserves, and we'll come out with an economic study on this project. As it looks today, it looks to be a relatively important project and one that could add significant pathway back to the company. We today are still expanding this project and what it will be in the future, and we are in the middle of permitting this project. So where is Argonaut today and where is it going? As we look at Argonaut today, we are running some 200,000 ounces of production, as I said, at about $1,000 to $1,100 all-in cost today. They're relatively short mine lives in that 5-year type time range, and we're looking at moving from these higher cost, lower life assets to longer life, lower cost operations as we look to the future. As I said, all 3 of those development projects, we're on a very short time frame to moving them forward. At our 2 projects in Mexico, the San Antonio and the Serra de Gallo projects, we think we'll be hearing on the permitting here during the 4th quarter. And at our Magino project, while we have some of the main permits in hand, we're waiting for the final permit, which should be coming in the 3rd quarter of next year. So a relatively short time frame to really change the projection and profile for this company. That leads to a greater profile for production, a lower operating cost profile, and greater cash management. We will manage through this on a project by project type basis. So how does this look from an investment thesis or a portfolio perspective from you as an investor? Today, the market capitalization in US terms is about $285 million. The analyst consensus just on the producing assets and the cash within hand on the company today sits at about $350 million. The interesting thing when you think about these development companies is, as we heard this morning from the panel, they are being valued at a discount. We truly carry that, but we have tremendous leverage, not only to those resources I spoke about in the ground, but also in what they can do in the future. If you look at the technical reports issued on those 3 assets, you'll see nearly $675 million worth of untapped value. That's what an investor is playing for when they enter into the Argonaut share. So how are we doing towards delivering on that? Our near-term catalysts are moving quite well. At our El Castillo complex, we just expanded the project by nearly 50% and should start to see dividends here in the 4th quarter and into next year on the production profile and lower operating cost profile. At the Magino project, we have started this underground drilling. We're well advanced on that last permit. As I said, we expect to receive that in the 3rd quarter of next year. And our Serra de Gallo and San Antonio projects are both advanced in permitting. We should hear during the 4th quarter of this year, and also issue a new technical report out on the Serra de Gallo project, which will bring those resources and reserves into our status and grow our reserve and resource base. When it comes to valuation, development companies are paid less, as we heard. When you think about the valuations for a producer with lower risk, because the cash flow that is being generated from the projects will then in turn build the next phase or next round of development for the company, you'll see that they are valued at a lower price to net asset valuation, cash flow, and EBITDA. We have tremendous leverage, not only to the gold in the ground, but also tremendous leverage from the cash flow to really build out that profile and pipeline and deliver further for our shareholders in the near-term future. Our focus and goals over the next coming year are to advance on that 200,000 ounces of production, build our balance sheet, de-risk our development projects, and transform this company into a 300,000 to 500,000 ounce producer in the lower quartile of operating cost. That concludes my presentation for today. Are there any questions? Okay, we'll turn things back over.